We're not out of the woods yet. Today, I want to set out why financial markets have rallied so aggressively in July, but why more particularly I'm concerned that we could have further bouts of weakness, potentially much greater weakness later in the year. So let's start off by looking at the July rally. Global equities, their best month in more than a year. Same for global bonds. And you can see such a sharp turnaround relative to the trend of the past couple of months where equities and bonds have been under significant pressure. So what's going on? Let's look at inflation expectations and how central banks have responded. The white line on this chart shows the market's break-even inflation rate for the next 5 years. In other words, what does the bond market price for US inflation over the next 5 years? What you see starting the year, inflation expectations were really elevated, around 3%, push higher as we got those terrible US inflation prints. But central banks have responded. So the Fed coming through, hiking 25, then 50, 75, 75, and talking very aggressively. Now, the Fed has had some success. Just look at how inflation expectations have eased off in the past couple of months, a reflection that the market believes the Fed and others will get inflation under control, as well as a related decline in commodity prices. So the Fed's talk has been self-fulfilling. Just talking aggressively has made markets less worried about inflation. And as inflation expectations ease, well, then so does the amount that the Fed is going to have to hike. So Fed hiked 75 basis points last week, but the indications we're getting from the Fed is that they're probably going to slow down the hikes from here. Market is now broadly pricing that the September move will be 50 points as opposed to the 75, and then the Fed could even go to 25 base point hikes. Expectation now is the Fed funds rate will peak at around 3.3%. Go back 2 months, the market was thinking the Fed would have to hike all the way to 4%. So Fed has succeeded bringing down inflation expectations, and that reduces the amount it needs to hike. Therefore, the aggressive rallies in financial markets. I still worry, however, that we could go into recession, and I'll unpack that in a moment. But of course, you can ask me, John, isn't the US already in recession? Because last week we had the second quarter US GDP print, and once again it showed a decline of 0.9% on a seasonally adjusted annualized basis. So the US is now contracted in both the first quarter of this year and the second quarter, so 2 consecutive quarters of negative GDP growth, which in many people's minds seems to suggest a recession. This is probably not really the case. To understand this, just first think of all of how would you define a recession? So I think most of us would define it when people are losing jobs, businesses are closing down, a very tough economic environment. That certainly wasn't the case in the US in the first half of the year. Job growth was still stellar. Consumption spending growth was very strong. In fact, if we break it down, what has happened is in the GDP prints, GDP has been distorted by issues such as foreign trade and inventory buildups. Really, the underlying strength in the US economy remained very much intact in the first half of the year. Now, in the US, there's no such thing as an official recession. Neither the Fed or the Treasury, the government in general, defines a recession. The unofficial arbitrator of recessions has been the National Bureau of Economic Research, NBER. They've been documenting US economic cycles for decades now. And generally, the market takes their definition of a recession. So the NBER comes around, defines if we are in a recession or not. Almost certainly, the first 6 months of this year is not going to be defined by the NBER as a recession. NBER defines a recession as a sustained, deep and widespread contraction in economic activity. They pay particular attention to issues such as job creation, consumer spending, and once again, those conditions are not there. Those conditions are not there yet. I still remain very worried that we could have a recession in the second half of the year. Once again, let's look at that picture of the Fed funds rate and expected inflation. Just look at how quickly the Fed funds rate has gone up. In 6 months, broadly, the Fed has hiked as much as they did in the previous entire cycle that lasted a number of years. The Fed funds rate is already back to the peak of the last cycle. And remember, that peak generated an economic slowdown. And of course, the Fed is still expected to hike more from here. Fed hiked 75 in June, 75 at the end of July. We now have to wait and see the impact of that. So with a hike at the end of July, maybe the August data will give us the first indications of how the economy is responding. But probably we have to wait for September and October to really get a proper assessment. So for the next few months, we're now data dependent. The Fed is data dependent on how much they're going to hike in September. The Rand, global markets are now data dependent. By that, I mean, is global inflation, particularly US inflation, going to now slow from these elevated levels? Will the US economy only slow and not go into a recession, which creates financial market stress? So data watching we are. Now, the existing data has not been very good. At the end of last week, we got the most recent July CPI print for the Eurozone. Once again, inflation coming in above expectations at 8.9%. So Eurozone inflation close to 9, US inflation just over 9. That's still a very worrying inflationary scenario. South African markets, of course, have been caught up in this wave of global relief, global rally. Look at our swap rates have come down 50 to 60 points, depending where you are on the rally. Swaps in our mind still remain too expensive for interest rate hedging, but nevertheless a significant rally there. We've also seen very good movements in the Rand. While the Rand didn't catch up to that slightly weaker dollar, but last week outperforming relative to euro dollar that was stable, getting down to that key technical level at 16.38. Now, once again, our markets are data dependent. If over the next few months it does appear that the US economy is just slowing and can avoid a recession, then the Rand can continue to rally. In my mind, I still think the probabilities are higher that the US economy is going to slow dramatically, so go into recession environment, and in that scenario, then the Rand will come under significant pressure. For the week ahead, data watching, even though this data is still not going to be showing us the full effects of the Fed hikes. Key data point, US non-farm payrolls out on Friday. The expectation is job growth will slow, but not slow dramatically. So far, pointing to that mild downside. Dramatic slowdown will worry financial markets significantly, but that is not expected. We also get PMI figures from around the world. By the time we're watching this video, the Chinese PMI figures over the weekend and early Monday will be out. Today we have our own PMI figure in South Africa, and then the US PMI figure, the ISM, on Monday, followed by the US Services PMI, Services ISM on Wednesday. So quite a lot of data to watch there. One particular event that stands out for us is the OPEC Plus meeting, so OPEC and Russia meeting to consider oil production. It's a particularly interesting meeting because OPEC has now brought back all the production that they cut during COVID. So over the past 18 months, every month they've been bringing back some of the oil cuts, and we're now back at the level. So at this stage, they are not promising to bring back any more production. However, the Europeans, the US authorities are putting a lot of pressure on OPEC to pump more. Biden, of course, was in the Middle East meeting with many of the leaders of the OPEC members, presumably asking them to keep on pumping. So what will OPEC do? Well, we suspect OPEC will give a token increase in production. You got to reward Biden in some sense for coming to visit your country, but not a dramatic increase in production, and certainly not promising continuous production increases that are going to relieve global oil prices and so global inflationary pressures. All told, where are we at the moment? Well, we're not out the woods. We had a nice, strong relief rally in July. However, we still got to see the effects of all the central bank hiking coming through. Over the next few months now, we're going to be data dependent, looking particularly at the US. Is the US going to go into recession or not? Eurozone looking even more likely to go into a recession. So potential financial market stress, weakness in the Rand, if the data over the next few weeks, months is very poor, relief if it's not. Good luck for the week ahead.